Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Dennis Dick here on Fed Forecast Friday. And we have Peter Schiff on the line, CEO and Chief Global Strategist at Euro Pacific Capital. Good morning, Peter.
Good morning. How are you?
We're doing good. So we're getting things started off with the new year, and all the buzz is about the Fed, what they're going to do in 2015. So could you just give us your quick outlook, for the Fed, and perhaps throw in its impact on the markets?
Well, I think the Fed is going to keep on pretending that what they've created is legitimate recovery, but what they've actually done is inflated the biggest bubble yet. This is bigger than the Fed-induced NASDAQ bubble of the 1990s or the housing bubble that we had more recently. I think this bubble is probably bigger than both those bubbles combined. And unfortunately, it needs a lot more air or it's going to pop. And I think the Fed knows the bubble is too big to pop. That's why it just talks about raising interest rates but doesn't actually do it because it's afraid of popping the bubble. But I think at some point we'll get enough weak economic data that the Fed is going to have to drop the pretense that the economy is strong, and we're going to be looking at QE4 rather than higher interest rates.
So you don't think they're going to raise interest rates in 2015?
I think the odds are they won't. If they do, it'll just be a trivial amount, and they won't follow it up with an additional hikes. They'll reverse it and go back to zero and launch QE4 because I do not think the Fed is willing to allow the next recession. And I think that if the Fed were to raise interest rates, it would bring about a financial crisis that would be on an order of magnitude far greater than the one we had in 2008.
So the Fed is basically stuck here. They can't raise interest rates and risk crippling the economy and obviously hurting the overall markets here. So they're basically stuck.
Well, I think raising interest rates and crippling the markets would actually help the economy. I think one of the reasons that it's, we don't have a real recovery is because of the Fed. Unfortunately, if we want to have real economic progress, if we want to have a productive economy that provides more economic output, that creates good-paying jobs for our citizens, we're going to have to let this bubble burst. The Fed didn't do it in 2000. They didn't do it in 2008. So they postponed the pain, and now it's going to be a lot more painful to have to deal with it. But the Fed should stop QE. They should raise interest rates, even though it will plunge us into a recession, even though it will collapse the stock market and the real estate market, even though it will result in a lot of big banks failing, even though it will result in the government having to slash spending and restructure its debts. All these bad things are going to happen if the Fed does the right thing. But the Fed is not going to do the right thing because they never do the right thing. So they are going to try to continue to reflate the bubble to postpone the day of reckoning, which is why they're going to do QE4. Not because they should do it, but because they will do it.
And now you're seeing some of these other world economies talk QE as well. Draghi's talking about it, and obviously over there too. Is that going to be the same thing that happen over in Europe?
Well, I think it's kind of like the Fed rate hikes. They talk about it, but they don't actually do it. And I don't think that the Germans will allow it. I don't think the Swiss, even though they're not part of the euro, they are the biggest buyer of euros. They've tied their currency, the Swiss franc, to the euro. They convinced the Swiss to vote down the Save Our Swiss Gold initiative. I don't think they can afford a QE in Europe. So I think there will be some forces that will stop Draghi and stop the ECB, but they don't stop him from jawboning. So they can keep talking about it. But I think what might happen in the Eurozone in 2014 is we will get an uptick in Euro area inflation, and that should put the kibosh on QE because the pretense is, we need to do QE because inflation isn't high enough. Well, I think they're going to get more inflation in Europe as measured by their consumer prices. Not that inflation is a good thing or rising prices. No, rising prices will just make the economy worse, but at least it will stop QE. So I think we're more likely to do QE4 than Europe is to do full-scale QE.
So this is all smoke and mirrors by the Fed then. What what they're coming out with their policy statements and where they're how they're monitoring the economy and the elements in the economy. So basically they're trying to pull the wool over our eyes?
That's all they do. I mean, that's basically the job of the Fed. They're really like a propaganda institution. Even if the Fed governors were cautious about the economy, even if they were worried, they would never express those opinions. They're always going to be bullish. In fact, they always are bullish. I mean, you can't find a period of time where the Fed was worried about something. I mean, in the economy. Go back to 1999. Before, just on the eve of the bursting of the dot-com bubble, Alan Greenspan was very optimistic. Ben Bernanke in 2007, even mid-2008, was optimistic about the economy right before the financial collapse. So they never see a problem, or if they do see it, they never admit it.
So if the Fed's just going to continue to support this market, do we just continue to buy equities? Does Dow just continue to climb every year, or does eventually everything come to roost despite the Fed trying to support the market?
Well, no, I don't think long-term just being in inflated U.S. stocks is going to deliver real inflation-adjusted returns and adjusted for what I believe will ultimately be a collapse of the dollar. I don't think, though, that this next round of QE4, is going to be as good for the U.S. markets as QEs 1, 2, and 3 were, because I think a lot of the problem is that the market is now very expensive, and it's also pricing in a lot of economic growth. And so if we end up getting weak GDP numbers for the fourth quarter and then the first quarter of next year, and corporate earnings estimates are taken down, that could be a counterbalance to the props that we get from QE4. So I don't know that the market will do that well with QE4. I think the Fed will be able to prevent the market from collapsing with QE4, which is what would happen without it. So I don't think we're going to see a repeat of 2008 or 2000 where the Dow gets cut in half. If we don't do QE4, then that will happen. But I don't think U.S. stocks, again, are going to be the best place to hide out. I think that you'll get a lot more traction in selected foreign stocks in countries that aren't going to be doing their own QE. I think commodities will recover with QE. I think oil prices will respond much better to QE4 than the stock market. And I think gold, which has really been in a pretty much of a stealth bear market for all of 2014, gold was up strongly in just about every currency except the U.S. dollar, where it was basically flat. But everybody thought that 2014 was going to be the year that gold got clobbered. Instead, it did relatively well. And I think if the Fed does QE4, probably the best asset class to be in will be gold.
So how should the individual investor position themselves? If you're taking all the factors that you're talking about, the opposite of really the mainstream of interest rates, not going up, and if anything, another QE4, the end of the year, people reevaluate their portfolios and look to 2015. Is there any, general moves you would recommend for investors?
Well, one thing that might happen with QE4 is that long-term interest rates might finally go up. I think the bond market might get a little uneasy about QE4 because they might realize the situation that the Fed is in. Because remember, what supported the bond market, what supports the dollar, is the false belief that QE is temporary and that the Fed can end it and that the Fed can normalize policy. But, from the very beginning, when the Fed did first QE, when they did QE1, I said it was a monetary roach motel, that they could check in, but they can never check out, that the exit strategy that they were pretending they had was a pretense, that they didn't have an exit strategy because exit was impossible. I said we would have more QEs than Rocky movies. We ended up having 3 of them so far. I believe the 4th one is coming because once you go down this road, you can never go back, which is a reason why the Europeans might not make the same mistake that we did. Look at Japan. How is QE working for Japan? It's a disaster over there. It's going to be a bigger disaster over here.
Let's move into oil. We saw oil move from $100 a barrel earlier last year, and now we're down at $52 a barrel here this morning. How does this impact the overall economy? Isn't this good? Isn't this naturally good for the U.S. economy as an importer of oil?
Well, you could have made the same argument in 2008 when the oil price dropped even more, yet it didn't stop the Great Recession from happening. Sure, falling prices are good for buyers. Just like when real estate prices went down in 2007, 2008. That was good if you wanted to buy a house because the prices came down. But you have to look at what else is going on in the economy. One thing is that during the last several years, because oil prices were much higher, we developed an entire industry, a fracking, shale-based industry, which created almost all the good-paying jobs of the so-called recovery. In addition, those industries borrowed a lot of money based on the assumption that oil prices would stay $80 a barrel or higher. And if oil is where it is now, which is 52, 53, we're making a new low on the move just today. If oil prices stay around $50 or lower, all of these investments are going to turn out to be malinvestments. You're going to have massive bankruptcies and layoffs in the energy sector. And even though falling oil prices will be a buffer because they will be good for the consumer, a lot of consumers will be unemployed. A lot of investors are going to lose money. And I think the impact on the economy from the busting of what would be an oil bubble will be more severe than the bursting of the dot-com bubble in 2000. And oil prices were a lot lower then than they are now. You guys there?
Yeah, we're here.
I heard. And then the other point I want to make, though, is if the Fed does raise interest rates and doesn't do QE4, the oil market is not the only market that's going to implode. The same thing that you're seeing in the oil market will happen in the stock market and the real estate market. And so there is where you have an even more impact on the economy. If the real estate market collapses and the stock market collapses, there goes your recovery, which is built on the foundation of asset bubbles, because oil was propped up by the cheap money supplied by the Fed. But so was housing, and so is the stock market. And so oil is just maybe the first of many bubbles that will pop if the Fed doesn't continue to fill them with air.